topic is valuation of distressed asset, including specific provisions under IBC 2016. Distressed asset is an asset that is being sold because its owner is forced to sell it. Distressed asset usually sell for below their perceived value due to the fact that the owner is being forced to sell. Distress affects the valuation, and comparable benchmark may not be reliable in the valuation of a distressed asset. Various other factors come into play while valuing a distressed asset. With the increase in number of distressed assets, there is a considerable work for valuers in this field. Considering the significance of subject for valuers, we have selected it for CIRP. We are sure that it will be useful for participants in their professional practices. The speaker on this subject today is Mr. Yogesh sir. He is an accomplished practicing professional with very high qualification. He is BCom, AMCom, ICWA, CPA, USA. He is a registered valuer and an insolvency professional. He has working experience for over 38 years with IOC Amharat and Fortune 500 company and India's second major port KPT. He has rich knowledge of indirect taxation, accounting processes, office automation that includes SAP and MS Office. Presently, he is a practicing cost and management accountant and advisor for complex issues related to indirect taxes. He is a registered valuer for securities and financial assets and an insolvency professional. With over 30 years of professional experience, together with high academic qualification, Sir is very well respected professional and teacher. It is going to be an interesting session for you all for next 2 hours. So over to you, sir. Thank you. Yogesh,
Thank
sir.
you. Thank you, Kajal madam. Thank you very much for your kind words. And
You're welcome, sir.
happy evening to each one of you. Happy day to each one of you. So as Kajal ma'am informed, our today's topic is on valuation of distressed companies or a distressed asset, and with reference to particular provisions under IBC. So as we all are aware, presently we are passing through probably the means a bad period of our life, worst period of our life, because it all started with the COVID in 2019. COVID 2019, that is in India, actually means lockdown were imposed somewhere in March 2020. So after that, as we are aware, actually, this war between Ukraine and Russia is ongoing from last more than 9 months. And coupled with that, actually, the relationship between the major economy like Russia and USA, or yes, USA and the China is not good. So under all these, actually, there are chances of companies going into distress. So chances are increased, and particularly with reference to the present inflationary pressure. So in that circumstances, we will today analyze the provisions under IBC relating to the valuation of the distressed companies. So as we are aware, the credit for the acceptance or acceptance of registered valuer concept in India, that goes to the IBC, because prior to 2017 or prior to 2018, valuations assignment were being done, but there is no regulator for the valuation assignment. There was no regulator for the valuation assignment. So once this IBC or Insolvency and Bankruptcy Code that was implemented in India from 2016 onward, so it was implemented in India effective from 2016 onwards. So when a company means process of CIRP started, that is a corporate insolvency resolution process that started. So at that time, actually, valuation of asset of the companies under CIRP was done by the RP. So at that time, actually, it was observed that the value of the asset means value of the asset against which a bank or a financial institution they have given the loan. That is much higher as compared to actual value when a company went into a CIRP. In some of the cases, or in majority of the cases, it was observed that the difference was as high as 80%, 90% and all. So because of that, IBBI, the Insolvency and Bankruptcy Board of India, that highlighted before a central government the need for a registered valuer or for a regulation of the profession of valuers. So because of that, actually, Section 247 of Companies Act was notified in 2017. As we are aware, Companies Act 2013 was implemented in 2013 onwards. But the provision relating to the valuation, that is Section 247 or Chapter 17 of the Companies Act 2017, that was not implemented, that was not notified. So after this need for regulating the profession of valuation, that was highlighted, the Section 247 was made effective. And under Section 247, the Companies Registered Valuer and Valuation Rules 2017 were notified. So, as a temporary measure, actually, the IBBI or the Insolvency and Bankruptcy Board of India, that is recognized as the authority under the Companies Rule. As we all are aware, presently, Valuation Bill 2020, that is pending before the Parliament for approval, for enacting it, actually. So once that Valuation Bill 2020, that is finally passed or cleared by the Parliament, so after that regulator for the profession of valuation, that will be established in India. So in the meantime, actually, the IBBI or the Insolvency and Bankruptcy Board of India, that is the authority. So our today's discussion will be with reference to provisions under IBC. As we all are aware, separate provisions are there in a SURFACE Act. So you will appreciate that in a limited time of 2 hours, it will not be feasible to cover all provisions under all other acts. So our focus today will be on IBC related provision. So with that brief background, what I will do, I will share my presentation and we will move ahead. So just give me 1 minute. So I hope my PPT is visible to each one of you. So that today's topic is on valuation of distressed asset, including specific provisions under IBC. So we will start with preliminary, and we will start with these information. So as we are aware, the IBBI, that is Insolvency and Bankruptcy Board of India, that publishes quarterly news report. So these data I have taken from the latest newsletter of the IBBI, that is July to September 2022. So as per that, actually, this is information relating to a corporate insolvency resolution process, that is relating to the companies which have entered into CIRP process or a corporate insolvency resolution process. So as we can see, as on 30th September 2022, around 5,893 companies have entered into the process of CIRP, out of which around 3,900 cases are closed and around 1,947 cases the CIRP process is still ongoing. So as we are aware, when IBC was implemented in India effective from 2016 onwards, or December 2016 onwards. So at that time, actually, the threshold of a default, that was 1 lakh rupees. So any corporate person or any corporate debtor, if it failed to pay 1 lakh rupees, even 1 lakh rupees to its creditors, then the creditor can apply for the CIRP process. That threshold is now increased to 1 crore rupees effective from March 2020. That is after this COVID 2019 started in India. So present threshold is actually 1 crore rupees. And because of that, actually, now the number of application or the number of cases are going down under the IBC. So this is the picture of CIRP process. May I request, please mute yourself, sir. So this is the picture as at 30th September 2022. And this is the sectoral distribution of CIRP. So for a valuer, actually, it is imperative to know exactly under which company that is going into distress, or that companies are going into CIRP. So as we are aware, globally, there are 11 major sector. Those are classified or recognized as there are 3 valuation approaches which are recognized globally. So there are around 11 sectors that are classified, and under those 11 sectors, there are actually around 50 industry. Around that means under those 50 industry, there are around 150 sub-industry, and under those 150 sub-industry, the companies or the business entity fall. So that is the classification, and as a registered valuer, we all are aware the characteristics of all the company will be different. So as we know, no two human being or no two natural person are similar in this world. So the same is applicable to artificial persons like corporate companies or limited liability partnership and all. So for a valuation assignment, it is imperative that we should be aware exactly which is the sector which is affected most. So from these data, we can see the majority is manufacturing sector. So majority companies which are affected is under manufacturing. And if we add another 21% and construction, so that will give us around 71% companies which are from manufacturing, real estate and construction company. So this is the sectoral distribution of CIRP admission or companies which went into CIRP process. Now this is the trend. So as we are aware, under IBC, actually all the creditors, they are mainly classified under 2 categories. That is financial creditor and the operational creditor. So financial creditors are those who give finance or who provide finance to companies against the time value of money. So mainly banks and financial institutions, they are considered to be the financial creditors under the IBC, and operational creditor will include suppliers of goods or provider of services or employees of the corporate person or the companies, and the statutory dues under various laws. So that will include direct tax, indirect tax, etc., like income tax or GST and all. So those 4 category, that is supplier of goods, provider of services, employees of the company, and the statutory dues. So those four categories come under the operational creditor. So application for the commencement of the CIRP that can be made either by the financial creditor or by the operational creditor or by the corporate person itself. So this is the information relating to which category exactly made application for commencement of CIRP. So as we can see, as at September 2022, 2,531 financial creditor, they actually started this CIRP process, or they made application for a commencement of the CIRP process. Another 3,000 plus operational creditor, they made application for a commencement of the CIRP, and around 350 corporate debtor, they themselves applied for a commencement of the CIRP process. So that is the background about application under the CIRP, or trend of initiation of CIRP. Now, this is the status of ongoing CIRP as on September 30, 2022. So, as we have seen, admitted cases are 5,893. Closed are 846, which are under appeal or review or settlement, and withdrawal. So after admission, actually there is a provision for a withdrawal of the CIRP process. So those provisions are under section 12A of the IBC. So under that provision, around 740 corporate debtor, they have already withdrawn their application and closed by resolution and closed by liquidation. So these are the figures relating to status of CIRP, and 270 means in case of 1,237, this CIRP is ongoing for more than 270 days. So as we are aware, under IBC, actually, the emphasis was placed on a timely resolution, and the time limits for each process was fixed. But this is the real picture as per the figures which are provided by the IBBI. So in case of 1,000 around 1,237 cases, the CIRP is ongoing for more than 270 days. And like that, around 212 cases, it is more than 180 days, but less than 270 days. So this will provide us a picture about the process which is ongoing. And this is the timeline of ongoing liquidation process. So originally the period for completion of liquidation, that was fixed at 2 years, which was subsequently revised to 1 year. So as per this figure, in around 50% cases, the liquidation process is ongoing for more than 2 years. So this will give a rough idea what is the position under the CIRP. So now we will move to what exactly is the distress asset, or what exactly is the meaning of distress, or what exactly is the meaning of bankruptcy. So a bankruptcy that will result from the falling market capitalization, or a falling sales, or a depleting retained earning of the company, or a negative profit, or a negative working. So these are the possible causes of a bankruptcy of a company or a business entity. So that we will see in greater details in a subsequent slide. So these are the main causes of bankruptcy. Now, what exactly is the meaning of a distress company or a distress asset? Now, distress, it can happen due to two reasons mainly. Number one, economic distress, and number two, financial distress. So economic distress, that is not within the control of the individual company. So like we discuss present macroeconomic situation. So under that, actually, when these lockdown restrictions were imposed, so many companies failed due to a lockdown situation, because entire world came to a standstill. So that is the reason a company may convert into the distress, a good company which is doing good business, but because of that situation, a company may turn into the distress. So that is economic distress, one example of economic distress. And apart from that, there can be financial distress also. So what exactly is economic distress? So economic distress is broad-based and affects most company operating in the economy, and normally outside the control of the company, and often leads to financial distress. So what is the financial distress? So a financial distress, that is companies under financial distress have difficulty in paying off their financial obligation to their creditors, and it is always critical to identify the nature of distress, whether it is a economic distress or whether it is a financial distress. So that is very important to ascertain before undertaking the valuation assignment of any company under distress. So this is continuing with the meaning of distress company. So corporate distress, that stands for a situation in a firm when it is unable to meet its debt, and when the value of the total assets of a company is insufficient to discharge its total external liabilities, so that company can be said to be a distress company. And distress assets are usually put up for sale at a cheap price because the owner of the asset is forced to sell. So these are all characteristics of a distress asset or a distress company. And there may be several reasons for a distress, such as bankruptcy, excessive debt, or regulatory constraint, etc. So these detail we will see in these reasons we will see in detail in subsequent slides. So it is even possible to sell the debt itself to another person at less than the book value. And typically a distress company is one which is in major financial difficulty, usually either in a default or close to a default. So these are the means a summary of meaning of the distress. Now these are the factors which are responsible for a corporate distress, and these are the internal factor. So these are not external factor, these are the internal factor. So in a majority of company, there may be some shortcoming on the part of the company. So like outdated production process. So we have seen a number of companies which have gone out of existence because of the outdated production process. So as we all are aware, today's era is era of automation, and continuously actually new and new developments are coming. So because of that, if a company actually,
Hello.
yes sir, any questions sir?
Not clear. I'm here.
Hello sir, you are not audible. Any questions sir? Nikaraman Saab, any question? You are not audible, sir. So it seems it was by mistake. So we will continue. So outdated production process, that is one of the factor. Now on each of these factor we can discuss at length because these are the factor responsible for turning a sound company into distress. But since the time is limited, we will just go through the list actually because we have a lot more to cover. So these are the factor: outdated production process or high material costs. So as we are aware presently, the crude oil prices, petroleum prices after this war between Ukraine and Russia, so that is going high and high. So because of that, if the major input of any company is relating to petroleum or gas, we can take airline industry also. So their input costs are very high because of that. And if they fail to actually pass on the cost to its ultimate customer, so that company can fail. So that is one reason. So high material cost, poor labor productivity, so that can also contribute in a company to convert into distress. Lack of efficient personal skilled labor or high wastage process, then excessive manpower, high labor turnover, lack of quality leadership, labor agitation, improper staff recruitment policy, huge overhead cost, or the poor production capacity, wrong site selection, wrong estimation of demand, production of goods without market survey, or improper sales strategy, defective pricing policy. So all these are internal factors which are responsible for the corporate distress. And these are the external factors which are responsible for the corporate distress. So external factor will include natural calamities like flood, earthquake, cyclone, etc., or a war-like situation, or a political unrest, or economic recession, or market staturization of a product, or unfavorable export and import policy, or unfavorable taxation policy of the government, or a shortage or a non-availability of raw material, shortage of power, problem of transportation, high cost of fund, imposition of government price control, and other social problems. So these are the external factors because of which a company go into the distress. So we have seen the internal factor which are responsible for corporate distress, and these are the external factor. Now we will go to the indicators, how to ascertain whether a company is in corporate distress. So with reference to operational activity, these are the indicators of distress. So low production capacity utilization, or high operating cost, or high rate of rejection of goods manufactured, so that will result into distress of the company, or a regular default in making payment to the suppliers, or a delay in payment of wages, or high rate of labor turnover, declining or a stagnant sales volume, or accumulation of finished stock in godown. So all these are actually reasons or indicators. So am I not audible? Because one of the participants say audio is not clear. So am I not audible to other
sir,
participant?
Yes, so you're audible.
sir. You're audible,
Okay.
sir.
Okay. So, sir, you need to check connectivity at your end, sir. Maybe a connectivity issue at your end, sir. Kindly check that. So these are the indicators for corporate distress relating to operating activities. And now we will go to the indicators of corporate distress financing activity. So relating to financing activity, rapidly increasing debt, or regular default in repayment of debt, or failure in payment of a statutory liability, or continuous irregularity in case credit or overdraft account, or a repayment of one debt taking another debt. So all these are indicators of a corporate distress relating to the financing activity. Now, moving to books of account and other areas. So finalization of accounts longer after end of the accounting year. So we all are aware, just for example, Baiju's case. So Baiju actually failed to finalize his account in the recent past. So that is indicator relating to books of account of a company in distress. So finalization of accounts that is taking a long time after end of the accounting period, accounting year. So that is an indicator of financial distress in the company. Then a non-submission of financial information to the bankers or to the regulators like MCA and all. So that is another indicator of the financial distress. Then a window dressing in balance sheet. So we all are aware about the Satyam case. So a window dressing in the balance sheet. So that is another reason of corporate distress. Frequent changes in accounting policy. So as we are aware, the annual statement of or annual report of any company that will provide the accounting policies of the company, or financial statement of any company that will provide accounting policies of any company. So if company is making frequent changes in that, for example, a change in method of valuation of inventory. So that is indicative of financial distress. So frequent change in accounting policy, a delay in conducting the audit, or a fall in market value of the share, or high rate of turnover of key personnel, or frequent changes in the management. So as a valuer, it is essential that we ascertain the indicators of distress with reference to different perspective, like the operational perspective, or the financial activity perspective, or the books of account and other areas. So these are the indicators, and these are 6 signs that a business is in distress. So to summarize all the indicator which we have seen in a previous slide. So these are a major 6 signs which will indicate that a company is in a financial distress. So that will include constant lack of cash flow. Ultimately, cash is king. So if a sufficient cash is not generated by the company, so ultimately that company will go into the distress. So constant lack of cash flow, high interest payment. So because the company has taken very high loan, so that will ultimately result in a corporate distress, or a risk of default is very high when actually a high amount of debt is taken by the company, or the debt is taken at a very high rates of interest. So that is high interest payment that will result in high interest payment, defaulting and on payments of debt, extended debtor and creditor days, falling margin, and unhappiness of promoters or the employees. So that is the reason because of which company may turn into ultimately distress. So this is we have seen the preliminary part. Now we will go to a distress prediction model. So in actually a market, there are several distress prediction models which are available. So as a valuer, going through the financial statement of a company, we should be able to ascertain whether that company is in a distress or not. And on internet, there are many studies which are available of the company which went ultimately into distress. So instead of actually taking corrective action when company actually go into a distress, there are many many promoters who continuously measure performance of their company through these type of distress prediction model. So we will go through it. So what is distress prediction? So distress prediction, that is an essential issue in the field of finance, and a distress prediction, that is a very important tool used for a purpose of prediction of future probable financial condition of a corporate entity, so that financial crisis that may crop up soon can be predicted in advance. So that is very important. Now, if we refer to the balance sheet or a financial statement of, say, Kingfisher Airline. So, as we all are aware, Kingfisher Airline finally closed down its commercial operations somewhere in 2012, in the year 2012. But if we go through the balance sheet of Kingfisher Airline, which is available in the public domain, so if we go through the balance sheet of, say, 2008, 9, 2009, 10, so from it, with the use of this prediction model, we can very well ascertain that that company may ultimately go into the distress. So that is a distress prediction. That is very important tool. And using various model, now there are various model for a prediction of the distress. So I have covered just two models in these PPT, because it is not possible to cover all the models in limited time of 2 hours. So using various models of distress prediction, the management of a company comes to know about its future probable financial condition beforehand, and accordingly it may adopt appropriate remedial measure to avoid the financial crisis as predicted through various models of the distress prediction. So that is very important. Prevention is better than cure. So these distress prediction model, they actually in many cases work as the prevention rather than actual cure. So distress prediction, that is considered a very significant tool for a sustainment of a company in the long run. And promoters of many progressive companies, they regularly ascertain their financial position through this type of distress prediction model. So that distress prediction plays a very significant role in the survival of a company in the long run. So that is about distress prediction. And now, as I told you, in market or on internet, if we search, there are many distress prediction model. But this Altman model, which is known as the Z-score model or a Jetta model, so that is used very widely, not only in India, but that is used in other developed countries like USA or European countries and all. So that is used very widely globally. So that is known as Jetta model or Z-score model. Z-score model. So what is Altman model? So Z-score model that was introduced as way of predicting the probability that a company would collapse in the next 2 years, and the model proved to be accurate method for predicting the bankruptcy on several occasions. And when creating the Z-score model, Altman used a weighing system alongside other ratios that predicted the chances of a company going into bankruptcy. So there are 3 different Z-score for different types of business. So the original model that was released in 1968, and that was specifically designed for a public manufacturing company with assets in excess of $1 million. So that was the first Z score model. After that, because the original model, that is the model released in 68, that excluded a private company and non-manufacturing company with asset less than $1 million. So because of that, in 1983, later in 1983, so Altman developed two other models for use with smaller private manufacturing companies. So a model Z score that was developed specifically for private manufacturing company, while model B was created for a non-publicly traded company. So in 83, Z score model comprised a varied paying predictability scoring system and the variable. So what exactly is the Z score model? So that is that accounting ratio based model. So this Z score model is a accounting ratio based model, and this model, which is also known as Jetta or Z score model, that was developed as we have seen in 68, and 5 of the possible 22 financial and economic ratio that are chosen in consideration of the predictive power of bankruptcy of each variable, and that is mainly used in publicly traded firms. So this is the actually the ratio. This is the Z score model. So as we can see, there are 5 different ratio. So ratio number 1 is relating to working capital divided by the yes, madam, definitely I will share this PPT through the organizer of this session. Definitely I will share. So first ratio is working capital divided by a total asset. The second ratio is retained earning divided by total asset. A third ratio is relating to the EBIT, earning before interest and tax, divided by total asset. Fourth ratio is relating to market capitalization divided by the total liability. So what is market capitalization? It is the number of shares outstanding multiplied by the current market price per share. So that is market cap. And a fifth ratio is relating to total sales divided by total asset. So as we can see, in a 4 ratio, the denominator is total asset, and in a 1 ratio, that is total liability. So total assets are compared with reference to working capital, retained earning, total sale, and earning before interest and tax. And different weights are allocated to each ratio. So as we can see, for ratio number 1, a weight allocated is 1.2. Ratio number 2, weight allocated is 1.4. Ratio number 3, a weight allocated is 3.3. Ratio number 4, it is 0.6, and ratio number 5, it is 1. So these different weights are allocated. And this is the means weight in Altman model. So as we can see, maximum weight, that is 44%, that is allocated to ratio 3. So ratio 3, as we can see, that is relating to earning before interest and tax divided by total asset, followed by this 19% to ratio 2. So 19% is allocated to ratio 2, which is retained earning divided by total asset, and 16% to ratio 1, which is working capital to total asset. So like
Sir,
that, actually.
I have a question, sir.
Yeah, please go ahead,
Just
sir.
small doubt.
Please go ahead, sir.
Earnings before interest and tax, it is not EBITDA. That means depreciation has been minus from the.
Yes, sir.
And
yes,
then
sir.
we have calculated EBIT.
Very true, sir. Very true. Very true.
Okay.
In this, sir, EBITDA, normally you are right. EBITDA is widely used in valuation but here it is EBIT, not EBITDA, sir.
Okay. Okay.
Eh?
Thank you.
Sir, are these ratios are preferable? Earlier you have mentioned ratios. These are preferable ratios.
Yes, sir. This is means these are part of this particular model, sir. Based on these ratios, actually, bankruptcy is predicted not only in India but world over, sir.
No, but that's ratio. What is mentioned by sir? Whether it is a maximum that ratio to be there or
That I will show you, sir. That is there in how to interpret the final result. That is your question, sir. So
Yeah,
that is in next slide, sir.
Okay.
So this is the weight given. So 44%, 19%, 16%, 13%, and 8%. And this is how actually interpretation is drawn from the final result. So if a result of this particular model, if that is between 0 to 1.8, so that company will be regarded in the distress zone. If that result is between 1.8 and 3, so that company will be regarded in a gray zone. That means the chances of a company going into bankruptcy are very high. And if it is between 3 and 4, so that company will be regarded as safe zone. So I hope, sir, I have answered to your query, sir.
thank you, sir.
So what we will do, we will see this practically before we go to another model. So that in Excel, we will see one practical example so that it is more clear. So just allow me to share my Excel file. Just give me a minute. Now, this is just for illustration purpose. It can be made as complicated as possible, but you will appreciate in 2 hours it is not possible. Again, I will say. So, supposing this information is given to us, like equity share capital is 20 lakh, 12% preference share capital, that is 10 lakh, fixed asset is 35 lakh, current asset is 25 lakh. A fictitious asset is at 2,50,000. Current liability is 12 lakh. A debenture is say 25 lakh. A general reserve is 7,50,000. A profit and loss account having debit balance, that is a negative 5 lakh. A sales, that is 1 crore rupees. Earning before tax, that is 13 lakhs. And interest on debenture 2,15,000. Current market price of the share 14 rupees per share, and current market price of the preference share, so that is estimated at 125 rupees, and number of outstanding equity shares, so that is 2 lakh, and preference share, that is 1 lakh. So if we are having this information from the financial statement of any company, so what we will do, we will first make the working note in this fashion. So this is computation of the total asset. So that is a fixed asset. Again, that is formula driven, which is given here, fixed asset. So I will make it. So I hope it is visible, or I adjust it to 100 only so that it is more clear. So it is a formula driven, actually, nothing more than that. So there is a fixed asset which is given, that is 35 lakhs. Current asset that is given in the information 25 lakhs. So total asset 60 lakh. Like this, that is computation of the net working capital. So current asset is at 25 lakh. And current liability that is given at 12 lakh. So we are having net working capital of 13 lakh. Then retain earnings. So general reserve is at 7,50,000, and these P&L and a fictitious asset. So that is a negative 5 lakh and 2,50,000. So that will give us a retained earning of 0. And this is EBIT, earning before interest and tax. So in this information given is EBIT, that is earning before tax. So we are just adding interest to it. So to arrive at the earning before interest, interest and tax. So that is around 15,50,000. And market capitalization. So as we are aware, that is nothing but number of shares outstanding into current market price. So that will give us equity of 28 lakh and a preference share of 12,50,000. So total that will give us 40,50,000. And finally, it is total liability. So debenture is 25 lakh and the current liability at 12 lakh. So that is a total 37 lakh. So once we have this working ready, so we can compute these different ratio which are part of this model. So working capital by a total asset. So that will be 0.22. That is working capital 60 lakh and a net working capital of 13 lakh. So working capital of 13 lakh and net working capital of 13 lakh and total asset of 60 lakh. So a net working capital is 0.22 times of the total asset, and a retained earning is 0 because that here as we can see retained earning amount is 0. So retained earning by total asset we will get a 0 value, and EBIT by total asset similarly we will get 0.26. And this means market capitalization to total liability we will get 1.09, and total asset to total liability we will get 1.67. So once we have this, if we put these values in this formula, so that is 1.2 into 0.22 and 1.4 into 0, 3.3 into 0.26. 0.6 into 1.09 and 1 into 1.67. So that will give us a result of 3.44. So we can make a prediction since a score is more than 3. So we can make a prediction that this company is in safe zone. So that is how it is worked out. So once we have a financial statement of a company, so based on that, we can compute these 5 different types of ratio, and based on that, we can make the prediction. So that is ultimate Jeta score or a Jet score model. Now we will move to a next model, which is developed in India itself. So that is again a very important. So that is
Sir, pardon, this is Yogesh. Before you move to the next method, I have a question here, sir. If you
please
can allow
tell me,
me,
sir. Please, sir. Go ahead, sir.
Sir, here you have taken that the market value of share price of the company is share will affect the our Zeta score.
Yes, yes.
Right, sir?
Yes.
Sir, what exactly happens in share market there? Sometimes the share value price is superficially high, and vice versa also. So that will be.
It seems he has lost the connectivity, Yogesh ji. So I will give a reply to his query once he join actually. So actually, mainly this model is developed in US. So US and European countries and all, so their markets are regulated. So there they don't face. And in Indian share market also, maybe in a shorter duration, the price of a share, maybe it is artificially high or artificially low, but ultimately the price will be adjusted to its true value or the intrinsic value of the share. So in long run, actually the market price will no longer remain artificial, and there will be exception to each case. So they more or less the price of a share which is prevailing in the market, so that will be means nearer to its intrinsic value. So say, I hope it will clarify the question of Yogesh ji.
Sir,
Please.
can I just add to what you are saying?
Please.
Actually, if you look at the P ratio, price to
Yes.
earnings ratio of any company, and compare it to the industry norm, you
Yes.
will immediately know whether some play is happening in that share or not.
Very true.
For example, in one of the energy companies, while the industry norm is about 30 price earning ratio, that company is trading at 700 price to earning ratio. Clearly means there is some manipulation going on.
Very true, sir. Very true. So that manipulation, unless certain players are there which are interested in that manipulation, so that will be adjusted to its intrinsic price going by the demand and supply need. So ultimately, all the players in the market, they are supposed to be the knowledgeable. So once they are knowledgeable, so ultimately it will be adjusted to its intrinsic value. So may I request Shreyas ji, please mute whenever you are not talking. So I hope, sir, it is clear, sir. You have rightly pointed out that there are a certain manipulation in the market which is ongoing. So we cannot help actually. This is there will always be exception, but by and large this model is accepted globally. So I hope there are no more questions. We will move forward. So this, according to this National Council of Applied Economic Research, that is NCAER, and industrial undertaking. So we have to understand this is with reference to industrial undertakings only. So this study is applicable, or this model is applicable only to the industrial company. So industrial undertaking may be financially viable if its three elements are proved to be the positive. So these, according to that, these three elements or parameter for predicting the stages of corporate sickness. So these are case profit position, a profitability measure, net working capital position, which is a liquidity measure, and net worth position, which is a solvency measure. So in a firm, if any of the above three elements or the parameters are found to be negative, so it may be considered that the firm has a tendency of becoming the sick. If any two of the above three elements or the parameters, so those are found to be negative in a firm, so it may be considered that the firm possesses incipient sickness. And if all the above three elements or the parameter are found to be negative in a firm, so it may be considered that the firm is fully sick. So this is again another way of predicting the bankruptcy. So again, we will go to Excel sheet, and we will understand this with one example. So just give me 1 minute. So if this information is given to us, equity share, reserves and surplus, long-term liability, current liability, fixed asset, current asset, profit and loss account, depreciation, preliminary expenses, and a net loss. So from these, we can compute the case profit. So net profit plus depreciation and preliminary expenses. So that will be the adjusted case profit. So that is in this case is negative 12.3. So depreciation and preliminary expenses written off, as we are aware, that is a non-case item. So that is added back to the net profit. So in this case, since it was a negative, so that amount of negative profit is reduced by adding these non-case items. And then we have this net working capital. So that will be current asset minus current liability. So that net working capital in this case again is negative, and a working computation of net worth. So equity, capital, reserves and surplus, and a profit and a loss account. So that will give us the net worth. So that is also negative. So we can draw a conclusion as per this NCAER research study. If any one of the above three parameters become negative, in case of an enterprise, it can be predicted that the enterprise has a tendency towards sickness. So in this case, all three parameters are in negative value. So company is fully sick, a stage of the sickness. So like that, we can have analysis of any company. Now this is just an illustration example based on financial statements of the company which are before us. We can draw a such conclusion. So this is
what
just,
is the cash profit, sir? Cash profit by profit by loss. What is the cash profit here?
Cash profit means all non-cash expenses. So depreciation is considered to be the non-cash expenses.
Okay,
because that is a provision only, sir.
Okay.
So those are added back to the actual profit or loss.
Sir, I have another question.
Yeah, please, sir.
Yeah, okay. Now, the second factor that we talked about, which is also an indicator of distress, you'd mentioned, was computation of net working capital.
Yes.
Now, for certain industries, depending on the nature of the industry, of course, the net working capital is typically negative. Secondly, it may also depend on the growth stage of a particular company. Typically, companies which have a higher growth are in higher need of working capital, and at times, the current liabilities for such companies are way higher than current assets. So what I'm trying to say is that a negative net working capital may not necessarily be an indicator of distress in all cases.
Very true, sir. Very true. So that will depend upon case to case. This is just an indicator. That is not a real position, sir. So this is giving, as we told, that is many progressive company that use it as a preventive measure, as I informed earlier also. So once these are negative, so if that negative position remains for a longer duration, so probably that may convert into the distress. So that is a good sign for any promoter to improve upon it. So that is providing an indicator, sir.
Sir, can I add to it this?
Yeah, please, sir.
Normally what happens is if your working capital is negative, it is obviously being financed in the balance sheet by the long-term liabilities. So if your working capital is negative, that means, you are using up some of your long-term assets, long-term liabilities to finance short-term liabilities.
Very true, which is not desirable.
Which is not desirable.
So they very truly summarized, sir. So usage of long-term liability to finance a short-term asset, that is also not desirable in a long run. So these all are prediction models, sir. Again, these are the prediction model and useful actually. And many progressive companies are using these studies.
Excuse me, sir.
Please, sir. Please, sir.
Yeah, all the things you are explaining now, it has to be done once the company becomes bankruptcy, or what, sir?
No, that is how I am telling, sir. Bankruptcy is just after company turns into bankruptcy, it is nothing but post-mortem. So again and again, I am explaining these are the prediction models. So if that is used prior to company turning into bankruptcy, so that will actually act as a preventive measure, sir.
Okay.
Sir, so prevention is better than cure. Actually, I quoted that in the before also, sir.
Sir, this calculation, can a registered valuer do, or only IPs can do this one?
No, means supposing you are given a valuation assignment, not of a company in distress. Supposing you are coming across valuation of a solvent company. So in that, actually, how far the projection of that company is workable. So you can very well have an idea based on these studies, sir.
Okay. Sir, I have one more question, sir.
Please,
Like,
sir.
all of us are IBB registered valuer. Can we do valuation only under Companies Act, or we can do all types of valuation? This is
So, sir, presently, actually, as we are aware, Companies Act, it is mandatory. The concept of registered valuer is accepted under Section 247. Similarly, under IBC, that is Insolvency and Bankruptcy Code, all provision necessarily valuation should be through a registered valuer. Other acts like SEBI regulation, the FEMA regulation, income tax. So under that, it is not fully accepted. Like in some provision, SEBI regulation, the concept of registered valuer is accepted. In some other provision, it is either by the SEBI registered merchant banker class 1 or by the chartered accountant in some cases. So that, as I informed you, sir, Valuation Bill 2020 is presently pending before the Parliament. So once that bill is passed, one regulatory authority for the valuation is created. Then probably under all act provision, all other act provision also, so the concept of registered valuer will be accepted. So under at present, actually, Companies Act all provision, IBC all provision, some provision of SEBI regulation, FEMA regulation, income tax and all. So that is the situation, sir.
okay. Thank you.
So I hope I have given reply to your question, sir.
Yes, sir.
So if no further question, then we will move ahead.
Yes,
So this is a prediction of bankruptcy in Asia. So there have been, and these I have taken from a Journal of Applied Business Research. So a very important information. So there have been many studies of bankruptcy in Asia, with the majority finding that causes of bankruptcy in Asian country that can be quite different from studies in the Western countries. So the analysis of a financial ratio has been the primary method used for analysis. And in the West, financial strength has been the primary indicator of the ability to avoid the bankruptcy. Other factors have also come into play, with the inability to adjust to changing environmental factor being the major cause. So if a company is not adjusting itself to the changing needs of the customer, or it is not adjusting to the automation level, pace of automation, so that company will ultimately fail. So such factor are just given here: customer preference, social norm, new legal requirement, and rapidly changing global competitive forces have meant that companies must adjust or die. So as these forces continue, company must find better ways to predict bankruptcy. And two primary methods used in West to predict bankruptcy are Altman's Z-score and Olson's O-score. So as I told you, in market, actually, if we search through the internet, there are many models which are available for a prediction of bankruptcy. In India, Gupta's model is also very famous. But you will appreciate that in 2 hours, it will not be feasible to cover all types of model. So we have covered these 2 types of model. So now we will move to suggested methods of valuation of distress company. Because we all come across problems in valuation of distress company. In major cases, actually, the RP or the resolution professional will say required information is not available, or the assets are there on the books of account, but physically it is not there. So what are the suggested methods? So these I have just made a list of. Unlike much of security analysis for a non-distress firm, the objective of valuation analysis in a distress setting, that is typically not to value the equity, but rather value the enterprise as a whole. So equity, though once company is in distress, so equity as it is will become of no value. So here a motive will be to value the enterprise as a whole. So two widely used approaches to valuation are relative valuation model, which is a comparable company, and comparable transaction value, where value is derived from the pricing of comparable asset and the discounted cash flow method. So as we are aware, there are three approaches: MIC, market income and cost. A question will come, which is the approach which is used widely. So as per a rough estimate, around 70 to 80% cases, a market approach is used to arrive at the valuation estimation as a primary method. This income approach, which is mainly DCF or a discounted cash flow method, so that is used as a secondary method, not as a primary method. So as we are all are aware, a valuer need to cross-check the valuation estimation that is arrived through one valuation approach. So for that, actually, it is income approach that is used as a secondary. So ultimately, what price is prevailing in the market, that will always have an upper head rather than the intrinsic value, which is computed by a valuer through a DCF with the help of projection. Because there are many assumptions which are made in the DCF model, and once number of assumptions are more, so judgment of valuer will come into play, subjectivity will come into play. So that is the reason, actually, whenever available, we should go by comparable company or the comparable transaction method, or the relative valuation or the valuation as per the market approach. So comparable. Yeah, please, sir.
Sorry. I have a question here.
Please, sir.
Now,
Please, sir.
when we talk of a comparable company, we would typically look at companies which are operating in the same industry and are typically of a similar size.
Yes.
Now, the factors which are relevant for our company under consideration may be very different from the other companies operating in the same industry. I mean, say, for example, we talked about factors which could be within the control of a company. And because of those factors, the company is in distress. That may not really hold good for other companies which are operating in the same industry. Now, if we apply the multiples of other companies operating in the same industry to the company under consideration which is in distress, that is likely to inflate the value of the company in distress unless we adjust the valuation after we apply the multiple of another company operating in the same industry.
Understood, sir. I understood your question. So actually, in subsequent slide, you will get reply to that. So since you have raised the question, what we will do, we will directly go to that slide. So there are two ways of doing that. One is you take the comparable of a solvent company, sound company. Then based on your judgment and ground reality and information and document available with you, you make the adjustment to arrive at valuation of the distress company. So that is one way of doing. Another way is you start with, another way is if you have information relating to comparable distress company, because in India, this concept is developing, sir, of distress company. That is entire market is getting developed in India. So that is a recent development as we are aware. But in developed countries like USA and Europe and all, so there is a separate market for a distress company. So they easily get, sir, information relating to that. And there are actually the information sources which provide the information of a similar transaction. But of course, that is at a cost. That those are the subscription models. So in this presentation, I have summarized that, sir. So that we will, since you have raised that question, so we will go to this. All these are there issues in evaluation of a distressed company. So if we take, for example, the market approach, so earning or value based multiples may not be appropriate, revenue based multiple better alternative, but are not free from possible issue. So recent transaction involving similar firm require proper matching of attributes. So all these are the issues which are involved. And finally, there is a suggestion. So that is a modified DCF. So use of probability distribution to determine the expected cash flow, simulated cash flow, a simulation with the Monte Carlo simulation. That is one method. Determine valuation under different scenarios. So scenario analysis, that is again very important, where input to DCF are simulated. So market share, etc. Determine probability of default and use it to determine expected valuation of company. And alternatively, take enterprise valuation under no distress and then adjust for the distress. So all these are actually, sir, possible steps which are suggested here. But you will appreciate that that cannot be generalized. So that will differ from each assignment. In valuation, each valuation assignment will be different. So I agree actually, sir, as it is in case of solvent company also, it is difficult to get a comparable from the market and a comparable transaction or comparable company. So in a case of distress company, that difficulty level will be added, sir. So
True, absolutely true.
sir, that is the reality. That we have to actually make our own judgment. So we will move forward if you do not have any further questions, sir. With your permission. So that once we go through this suggested approach in this PPT, probably you may get the answer. So comparable company approach, sometimes also referred to as a trading multiple valuation, that estimate the value of the target firm by applying the valuation multiples of peer firms to the target. And 3 steps are involved. So identify peer or comparable public traded firm, observe how the comparable firms are valued by the market, and apply that valuation to the target firm. So these are again suggested approaches. And most critical aspect of this analysis is the definition of a set of comparable company. So selecting comparable requires some judgment by the valuer. And fundamentally, comparable firms should match the target firm in terms of risk and growth prospect. So pure play of a peer firm would be an ideal comparable, but in most cases, these exact match does not exist. So as on a lighter side, we say in our real life, even the nature of two brother and sister is not the same. So how we can expect the characteristics of a two company that will be same. We can match to some extent on quantitative data, but qualitative aspect, it will be very difficult to match actually, as we are aware. The valuation is done considering 2 aspects, qualitative aspect and the quantitative aspect. So even if we are able to match 2 companies on a quantitative factor, it will be very difficult to match the 2 companies based on the qualitative measure. So Porter's 5 forces and all that will come into play in matching the qualitative aspect. So that is another very big subject in itself. And this is a discounted cash flow method. So a DCF, that is a forward-looking approach that estimate firm value as the discounted value of expected future cash flow. And it is sensitive to a number of assumptions used to derive the cash flow or the discount rate. So means in order to arrive the projection or the discount rate in itself, that will be a challenging assignment. In contrast to the relative valuation model, this approach requires that a valuer be explicit about this important assumption, and a DCF method are considered by some to be the most useful measure of intrinsic value. So that is by the Mr. Damodaran, observation by Mr. Aswast Damodaran. As we are aware, Mr. Aswast Damodaran is he is known as valuation guru, or he is recognized as a valuation guru worldwide. So adjusted present value, so that is another way of doing the valuation of a distressed firm. So there are several issues specific to valuation of firms in a financial distress or bankruptcy that lead to suggest a second DCF method that is based on an approach known as adjusted present value method. So under APV method, that is often easier to implement than the free cash flow approach, that is free cash flow to firm or a free cash flow to equity, FCFF or FCFE. So present value, adjusted present value or APV, that is more easier. So in that, what exactly is done, so that we will see. So that adjusted present value approach follows directly from the work of Moody, Gianni and Miller. So M&M model, and total enterprise value equals the sum of the values of the operating asset plus the present value of debt tax shield. So that is another way of doing the valuation, adjusted value method, APV. So in that, enterprise value will be arrived at by sum of value of operating assets. So their non-operating asset will not be considered. Like if a company has invested in land and that land is not used, so that will not be considered as an operating asset. So value of that will not be considered. So fair value of all operating asset plus the present value of debt tax shield. So only that will be considered in the enterprise value. So that is M&M model or the adjusted present value model. Now these are the phases of valuation of a distressed company. So analysis of the distress should begin with the fundamental analysis of the company in order to identify and analyze the causes of a crisis. And these causes can be occasional or a structural cause. So chances of recovery are there in occasional causes like this COVID-19. So that was one of event. So chances of recovery are there. But in other cases, structural distress, chances of recovery may be very less. So a fundamental analysis, so that will be based on financial and economic distress, so that we have seen what is a financial distress and what is economic distress. And could the financial distress be written off? So that is the question valuer or the promoter of a company should ask to itself or himself. And the evaluation will be carried out applying the most appropriate method. So these are the issues in evaluation of a distress company. It is not easy to get a clear-cut answer to all these questions. These questions are highlighted just for a reference purpose or just for indication. So under income approach, the valuer will face this issue, how to estimate the cash flow, because since company is in distress, probably there may not be the cash flow which are generated by the company. So it will be very difficult for making projections of the cash flow for the companies which are under distress. and a need for adjustment for higher volatility as well as a possible truncation of the cash flow, and what discount rate should be applied. So that is another question, because normally when a company is in distress, so a company will tend to borrow money at a very high interest rate. So that will actually enhance the value of debt or cost of debt of the company. So exactly which discount rate to apply, so that will be matter of judgment by the registered valuer. A market approach, so earning a value-based multiple may not be appropriate, and a revenue-based multiple better alternative, but are not free from a possible issue. And recent transaction involving similar firm that require proper matching. And liquidation valuation, so there will be some asset which are offered as a security, or charge is created against asset. So collateralized asset versus free asset, or distress sell discount. So review possibility of orderly liquidation. So as we are aware, under the premise of value, there are two types: orderly liquidation and forced liquidation. So that review needs to be done, and carry forward losses as a potential asset. So whether the acquirer of the company, of the distress company, whether he will get a tax benefit, that carry forward loss may become potential asset also in some cases, due to the tax benefits which are available to the acquirer, and a debt valuation. So that will be very important. And these are the issues in a distress asset. Again, continuing with that. So when the object of the valuation is a distress firm, it will have a higher cost of capital, as we discussed, in terms of both the cost of equity and cost of debt, and thus a lower firm value than a non-distress company. So it is obvious that when we discount the future cash flow at a higher discount rate, so that will give a lower present value estimation. So that is again a very important. So risk of financial distress must be included in the calculation of the cost of capital in order to capture the specific context of the observed company. So as we are aware, there are two measures of risk or volatility, that is beta and alpha. So a beta is a marketplace specific, alpha is a company or entity specific. So all these factors should be taken into consideration by the valuer in alpha factor. So as a consequence, the risk of financial distress as a company specific risk must be taken into account in the calculation of the discount rate. So these are again a modified DCF. So we discussed this simulation and all. So we will skip this. And these are actually cash flow approach. So historical data is less relevant for forecast. So forecast period can be broken down into transition period. So from distress back to a sound health, and period after distress, that is in a sound health. So as we are aware, projections are made in two consideration: explicit period and terminal value. So explicit period, generally it is taken for 5 years, going by the guidance given in Ind AS 113 or in IBS also. So normally it is for 5 years, but in case of a distress company, we can break it in two parts. That is a transition period, that is from distress back to sound health, and a period after distress, that is in sound health. And a distance to default, that could be useful to estimate expected cash flow. A terminal value could be based on firm returning to sound health. So all these are suggested method, and this issue will also be there in cash flow. What beta to use for equity adjustment are needed to account for a distress of stretch working capital need, market share pressure, difficulty to retain key employee, increase in financial cost, unique distress related cost, including liquidation cost, a shield may or may not be valuable, tax shield, So all these are a factor which needs to be considered. This is just an illustrative list which I have highlighted. Again, this is choosing the right comparable regular form, but make adjustment for a distress in multiple. Look for a mix of form that have liquidated and transition out of the distress in the past. So a valuer should have a good database, then only he will be able to identify this. So all these are suggested steps in evaluation of the distress company. And these are the challenges which are faced by valuer in companies which are under IBC. So no access or a limited access to the required document. So most of the time RP tells us that the promoters are not cooperating, and I have already filed the application before the adjudicating authority relating to the non-cooperation of the promoters. So all these are the issues. So no no access or limited access to the required document, a limited time for evaluation assignment in view of a strict timeline prescribed under the IBBI regulation. As we are aware, IBBI mostly it is timelines are fixed. CIRP timeline, fast track CIRP timeline, liquidation process timeline. So most of the time, RP will insist for completing the valuation assignment quickly. So limited time will be available to the valuer. Then no access or limited access to the premises of the corporate debtor. Then non-availability of the recent financial statement, limited or no access to books of accounts of the CD. Challenges in finding benchmark value in order to arrive at the liquidation value, and a non-availability of required document for evaluation of SFA, that is securities or a financial asset, particularly trade receivable, advances, intangible assets and all. So all these are the issues which are faced by the RV in the So any questions, sir? Radha Krishna, sir? So it seems it is by mistake. So non-availability. So all these are the issues in IBC, and we all are sailing in the same boat. We all are facing this issue, and there will not be a regular answer. Means any answer. Means general answer to this. It will depend in all cases. As a RV, we supposed to actually. We supposed to find answer to this question based on the ground reality of each case, or based on the documents and information that is available with us. So that is just I have highlighted this challenge. And now we will quickly move to provisions under IBC. This is the history of the corporate insolvency in India. Now I can take 1 hour to explain this, but since time is less, so we will skip this. Originally it was under a Companies Act 1956. So as we are aware, we the natural person, if we feel sick, what we do, we go to a doctor for a treatment. And once we are treated well, so we come out of the illness. So like that, actually artificial person like companies or LLP, they also feel sick due to various reasons. So they also require cure. So the company business model can fail because business is always challenging. So once a business model is failed, so promoters of that company should get opportunity for actually respectable exit. So unless that is provided, respectable exit, no other person will venture to take the risk. So that is the need of the hour. So those provision of winding up were not sufficiently provided under Companies Act 1956 or a SICA Act or RDDB or SURFACE Act or Companies Act. So that is how this Insolvency and Bankruptcy Code 2016 that is introduced in India. Now, as I told you, this will explanation to all this development will take its own time. So we will skip it for now. And this is relating to corporate person. So in respect of the individual and partnership firm, even today, these laws are still applicable. So this Presidency Towns Insolvency Act 1909. So this act has been repealed through this IBC 2016, but that is not enforced as yet because, as I told you, the part 3 of IBC that is not implemented in India so far. So provisions relating to individual and partnership firm. So that is how this Presidency Towns Insolvency Act 1909 that is still applicable in case of partnership firms and individual. So Presidency Towns Insolvency Act that is applicable to the Presidency Towns pre-independence era. So those Presidency Towns, as we are aware, that is Mumbai, that is Madras, and that is Calcutta. So to these actually, this Presidency Towns Insolvency Act is applicable. And to other towns in India, this Provincial Insolvency Act 1920 is applicable. And in case of a partnership, it is Partnership Act 1932. And these are the timelines of important event under the IBC. So it all started in August 2014 with the constitution of BLRC committee, that is Bankruptcy Law Reforms Committee. So if you get time, you download this BLRC report, which is freely available on the internet. That will provide a very good overview of development of insolvency in India. And Mr. Viswanathan, he is the chairman of this board. And this particular report that is written in a very simple language, very lucid language. Generally, all these reports are in technical language, but this is written in a very simple language. So if you get time, you download that and go through it. It will provide a very good insight. So that November 2015, this BLRC report is submitted and draft IBC was submitted. In December 2015, IBC was introduced in the Lok Sabha. So after that, this on 28th May 2016, assent was given by the Honorable President of India to the IBC, and this NCLT were constituted in India from 6th June 2016. So there is a whole lot of history beyond the constitution of NCLT in India. So as we are aware, the provisions relating to constitution of NCLT that were part of Companies Act 1956. So Companies Act 1956 was amended way back in 2002, but those provisions were challenged by the Madras Bar Association before the Madras High Court. And that remained pending for a very long period, and finally it was settled somewhere in 2012 by the Supreme Court. So by that time, actually, Companies Act 2013, that was in pipeline. So that is the reason Constitution took so much of time, Constitution of NCLT. As we all are aware, GST was implemented in India in 1st July 2017. But till this date, actually, the GST appellate tribunals are not constituted even after 5 years. So NCLT also took its own time in constitution, and 1/10/2016, so IBBI was established, and effective from 1/12/2016, IBC came into effect. That is, CIRP provisions were notified. So this is the structure of IBC. It is in 5 parts, part 1 to 5. And part 1 is preliminary, part 2 is CIRP, part 3 is insolvency resolution for individual and partnership firm. Part 4 is regulation of IP and IPA and information utility, and part 5 is miscellaneous, and there are 5 schedules. Oh, sorry, there are 12 schedules which are attached to IBC. So this is the structure of IBC. Now, as we are aware, IBC is process driven. So there are various processes which are attached under the IBC. These processes are corporate insolvency resolution process. That is part 2 of the IBC. CIRP is one process. Fast track CIRP. So fast track CIRP, that is applicable to small companies and the startup entities. So that is a fast track CIRP. Then liquidation process, voluntary liquidation process, and a pre-packaged insolvency resolution process. So pre-packaged insolvency resolution process, that is introduced under IBC in 2021, and that is relating to the MSME unit. So after COVID to 2020, the situation or financial strength of MSME unit in India, we all are aware that what deteriorated. So to rescue MSME, this pre-packaged CIRP process has been introduced in India. And for individual and partnership, it is fresh start process, insolvency and bankruptcy process. So in case of a company, the winding up process is a liquidation process. In case of individual, it is bankruptcy. So bankruptcy and liquidation, it is similar terms. This is the institutional framework under IBC. Under IBC, we have IPA or Insolvency Professional Agency and information utility. So concept of information utility, that is the new concept. Probably that is there only in India. So IBBI is regulating that, and under IPA, it is IP. So there are 2 regulators for insolvency professional, that is IPA and IBBI. So same is the case with registered valuer with us also. So RVO or registered valuer organization and the authority or IBBI are 2 regulators for all of us. So that is relating to institutional framework. And these are the summary of valuation provision under different regulations of the IBC. So that is a CIRP regulation, a liquidation process regulation. Then these are the voluntary liquidation process. Then differential transaction or undervalued transaction. Then fast track insolvency resolution, pre-packaged resolution. So all these are the provisions of valuation under IBC. I will forward these PPT through the organizer of this event. So you may go through it in detail. Since time is less, we are just running through it in order to complete on time. So this is the flow of a process under IBC. So first it will be CIRP. Any company will be admitted to CIRP first. And if a CIRP process fails, then a company will be go under the liquidation or the winding up process. So this is the flow of processes under the IBC for CIRP and liquidation. So in India, we call it as actually the CIRP and liquidation. In USA, as per USA Bankruptcy Act, they call it as Chapter 11 and Chapter 7. So that is very important so far as the USA is concerned. So if a filing for bankruptcy protection has become necessary, so Chapter 11 grants a company an opportunity to restructure. So similar to our CIRP process, its dates and continue operating. And chapter 7, that is a straight liquidation and a distribution of the sale proceeds of a company to its creditor. So that is chapter 11 and chapter 7, because we many times come across these chapter 11 of USA bankruptcy code and chapter 7 of USA bankruptcy code. So this is the difference. In India, actually, necessarily first company has to go through the CIRP process, then liquidation process. But in USA, there is a relaxation. So company may opt either to go for a chapter 11 process or for chapter 7 process. So that is the difference between a bankruptcy law in USA and India. So actually in means when what is the task of a registered valuer? So registered valuer need to ascertain fair value and liquidation value on the date of ICD, that is on the date of insolvency commencement date. So what is the meaning of fair value? So a meaning of fair value we may get under a different document like valuation IVS or a valuation standard or the index or the accounting standard. But whenever a definition or meaning is provided under a specific law provision, so that will always have upper hand. So under a CIRP regulation, the meaning of fair value and meaning of liquidation value is provided. So that is, we have to do valuation going by that meaning only. So what is the fair value according to CIRP regulations? So that means estimated realizable value of the asset of the corporate debtor if they were to be exchanged on insolvency commencement date, that is ICD, between a willing buyer and a willing seller in an arm's length transaction, that is transaction between two unrelated party, not related party. So arm's length transaction after proper marketing and where the parties had acted knowledgeably, prudently, and without compulsion. So we can actually draw 2-3 conclusions here. That fair value is actually ascertained at a marketplace. It is not entity specific. It is a marketplace specific. That is number one. Number two, that should be between two unrelated parties. That should not be between related party, because in case of a related party and unrelated party, there will be difference in a value. So this is specifically mentioned. It should be between two unrelated party or at arm's length transaction. So that is very, very important. And what is liquidation value? So that also means the estimated realizable value of the assets of the corporate debtor if the corporate debtor were to be liquidated on the insolvency commencement date. So that is liquidation value.
Sir, one question.
Yeah, please, sir.
It looks like liquidation value is kind of for sale. It is not between market participants. So therefore, it looks like it will be lower than the fair value.
Yes, sir. It will be lower than the fair value generally, sir. And this liquidation value again, this is the basis of value. So after basis of value, going by provisions under IVS 104, that is a general standard. So after this basis of value, we have to ascertain premise of value. So premise of value, that can be either orderly sale or the forced sale. So based on that premise of value, ultimately valuation approach will be selected. Based on valuation approach, valuation method will be selected. And finally, estimate of valuation will be arrived at. So under liquidation also, there can be both premises, forced sale, and the orderly liquidation.
Okay.
So these are the summary of provision concerning, so that we have seen. So this appointment of professional. So as we are aware, the two means as per section 227, the means RP will appoint two registered valuer for ascertaining the fair value and the liquidation value on ICD or insolvency commencement date. Now here I would like to highlight, since the time is very less, so I would like to highlight 2-3 points. So number one, this fair value and liquidation value shall be determined in the following manner. So two registered valuer appointed under regulations 27. So they shall submit to the RP an estimate of the fair value and liquidation value computed in accordance with the internationally accepted valuation standard. So since this guidance is specific, so we have to compute the valuation going by the international valuation standard, not any other standard. And after physical verification of the inventory and fixed assets of the corporate debtor. So that is also a very important. There are many case laws, many disciplinary order which are available in the public domain. In that, actually, registered valuer failed to make a physical verification before arriving at the valuation estimation. So there, actually, the disciplinary authority of the IBC, they have a disciplinary committee of the authority, that is IBPI, they have taken a penal measure against the concerned RV. So we have to be very careful. We have to do a valuation after a physical verification of inventory and the fixed asset. So that is the must and a need for a physical verification that is highlighted under each regulation of IBC. So that is very important, sir. We have to do it. And then another provision is there, if two estimate of the value in an asset class are significantly different, or on receipt of a proposal to appoint a third registered valuer. So this is a new development. Earlier, these provisions were not there, but now it is amended. So even a COC, that is Committee of Creditor, that can insist for appointment of the third valuer. So either because these two registered valuer, they will do the valuation independently. And if there is a significant difference in their valuation, so RP will appoint a third valuer, or if a COC insists, then also third registered valuer will be appointed. So that
Sir,
is.
I have a.
Please, sir. Please, sir.
Yeah, sorry, sir. I have a question here.
No issues, sir. Please, sir.
Regarding the clause 1A on the slide, where there's a
Okay.
requirement for a physical verification of
Okay,
inventory and fixed assets of the corporate data.
Hmm.
Now, does this regulation mean that the registered valuer himself is required to do the physical verification of inventory and fixed assets, or can an employee of a registered valuer entity or a consultant of a registered valuer entity also do this physical verification? I mean, is that okay, or is it required for the registered valuer to personally do the physical verification?
Sir, as per my understanding, it is a registered valuer who is signing the valuation report. So necessarily it should be conducted by the registered valuer, sir. So I will just take 2 minutes, since you have raised this issue, sir. As I told you, I was employed with the Indian Oil Corporation for 35 long years. And there also we were having a committee for the valuation of the scrap asset, or for the acquiring land for a petrol pump. So as you are aware, sir, we have petrol pump. Our company is having petrol pump across the country. So for that, one committee was constituted. Now, in one of the cases, actually, that committee was of the functional department and the finance, actually. So, in one of the case, what happened? The finance officer, he told the other two colleagues, because in a company, all will be officer working together. So, he told this on this particular date, it will not be possible for me to join you in the committee visit. So, you can do the valuation, and I will just sign the valuation report. Ultimately, what happened? Unfortunately, that valuation was challenged, and then a matter went to CBI and and all. So there, actually, the officer will start questioning from the basics. So they told, have you visited the site before valuation? So all three replied, yes, sir. So then they were told to furnish the proof of their visit, like the traveling claim and all. So that finance officer unfortunately failed to produce that because he had not physically visited. So that is one example. Another example is in a lockdown condition. In one of the cases, RP actually insisted to RV, since now lockdown is there, so your physical visit is not feasible. So what I will do, I will arrange a virtual inspection of the property for you, and based on that virtual inspection, you complete the valuation assignment. So actually, in that condition, many tasks were accomplished through virtually. So valuer see no problem in it, RV saw no problem in it, and he conducted the virtual inspection of the property and completed the valuation assignment. Unfortunately, that valuation report was challenged, and it went to disciplinary committee, and a disciplinary committee took a serious note of it, that RV has not done the physical verification. So penal action were taken, but because of that circumstances, some liberal view was taken. So as far as possible, sir, we should make it a point to physically verify the asset, carry out physical verification of the asset, and create a record of our visit. So that is more important, creation of the record. Yes, I had visited. And sir, you will also appreciate, or you will also agree with me, you are a technical person. RV is supposed to be a technical person. Now, supposing you are deputing your employee, so he may not have the level of expertise which you will have. So based on inspection of, say, a plant and machinery, the judgment which you will arrive at, so your employee may arrive at a different judgment, sir. So according to my understanding, it is necessary for a registered valuer himself to make physical verification, sir.
Sir, I have another scenario or a situation when we need to do a physical verification of the inventory. I understand that depending on the nature of the inventory, the physical verification needs to be done by the SFA valuer and or the land and building or plant and machinery valuer. Now, if the verification is required to be done by two valuers, say the SFA valuer as well as either of the two, as in either of land and building or plant and machinery valuer, if only one of the two do a physical verification, will that be acceptable?
Yes, yes, sir. According to me, it should be acceptable because both are the registered valuer only. But that should be specifically mentioned in the terms of engagement, sir. In terms of
Okay.
engagement, that should be made very clear that two registered valuer needs to give a valuation estimation, but physical inspection will be done by only one. And going by the nature of inventory, that will be sufficient if the physical verification is done by the one registered valuer. So that again will depend, sir, because that is not that is part non-compliance also. So you should take all security measure, sir. So that should be sufficient because that one register. But first of all, why there are circumstances the same asset is being valued by two different valuers. So we will have to go in detail of that also for same valuation of same asset, why there is need of valuation by two RV of a separate asset class, sir. So that also is a subject of discussion in itself, sir.
Okay, sir.
And sir. So valuation, sir, it is more challenging and means that we cannot arrive at a general consensus. So that will be based on the circumstances of each case, ground realities of each case. But as far as possible, we should actually highlight that in writing beforehand, like engagement, terms of engagement and all. So that is also very important. So this is what I wanted to highlight in CIRP, and this significantly different because we have seen if two estimates are significantly different. So what is the meaning of significantly different? So that is now incorporated in CIRP regulation. So that means a difference of 25% or more in liquidation value. It is not fair value, it is liquidation value under an asset class, and the same shall be calculated. So that is given. And finally, average of two closest estimate of value shall be considered. So that we have covered CIRP. So I have incorporated another other requirement under other regulation also. But since time is limited, we will actually close this. So at the end, I will say the worst bankruptcy in the world is the person who has lost his enthusiasm. So hौसले बुलंद रखने चाहिए. That is the conclusion. Whatever may be the adverse situation, we should not lose the enthusiasm. So that is the bottom line. So with that, actually, from my side, it is over in this limited time of 2 hours. The subject is very wide and we can discuss it for hours together if we go into further detail of that. But looking at the time constraint, whatever best inputs I can give you in this limited time, I have tried to do that. I hope it is useful to each one of you. And at the end, I thank each one of you for your attention. So before we conclude, if any questions are there, then questions are welcome. So I thank Gautam Kumarji for your kind words, sir. Thank you for your kind word.
Thank you very much, sir. Thank you.
Thank you.
Thank you, sir.
Thank you very much. Thank you very much.
Thank you, sir. Thank you very much, sir.
Thank you, sir. Thank you. So, Kajal madam, are you there? Can we conclude the session? I thank each one of you, as I can see in a chat box. I thank each one of you for your kind words. That will really provide encouragement to me. And Kajal madam, are you there? Savita madam, are you there? Can we conclude? Sarma sir, are you there? So Rao sir, any question? As I can see, you have raised your hand, sir. Any question, sir?
Sorry, sir. By mistake again. Thank you, sir.
No issue. Thank you, sir. So what I will do, I will call to organizer. Just give me a minute. It seems nobody is there. So just give me a minute.
Sir, I'm here. Sir.
So can we conclude? You are not audible, madam. Not audible, Kajal madam. Still not audible, madam. You can. It seems some technical issue at your end, madam.
Now I'm audible.
Yeah. Now,
Okay.
finally.
Yeah. Thank you, sir. Today Sharma sir is not there. So from on his behalf, I'm going to conclude the session. Thank you for this wonderful session. Hope everyone like it. And if anyone have any topic to cover by sir, please share with me so that we can share with the sir and discuss the topic to have for the future. Thank you so much.
So I think there is some connectivity issue at their end. So just give me a minute. I will talk to them so that this session can be ended.
Can we leave, sir?
I have spoken to the organizer. It seems there is some connectivity issue at their end. So we are ending our today's session, and I thank again each one of you for your kind word. And we will conclude now. You may leave the session now. And as I informed you, I will forward you this PPT through the organizer. Thank you very much to each one of you, sir. Sir and madams.
Okay, thank you very much, sir. Have a nice day.
Thank you very much, sir.
Thank you, sir. Thank you very much.
Thank you, sir. So kind of you. Thank you very much, sir.
हेलो। हाँ नमस्कार सर। हेलो। हाँ बिल्कुल सर, आपकी आवाज आ रही है सर। हाँ हाँ। एजेंट की एजेंट चाहिए कि वैल्यू चाहिए सर? एजेंट में मुझे पता करना पड़ेगा सर। हाँ बिल्कुल बस किसी भी एनबीएफसी का अपन को चाहिए, जितने भी फाइनेंस कंपनी में एजेंट कोई भी हो। हाँ बिल्कुल। हाँ 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 बिल्कुल, मैं पता करता हूँ। हाँ 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 हाँ। तो वो मेरा ये कहना है सर, वो दूसरे फाइनेंस कंपनी के होंगे सर वो एजेंट। हाँ 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 वो हाँ बिल्कुल बिल्कुल बिल्कुल, वो LIC के नहीं मिल पाएंगे सर में जो आप वो। हाँ तो मैं बात कर लूंगा सर। हाँ हाँ बिल्कुल बिल्कुल सर। हाँ हाँ बिल्कुल सर, बिल्कुल सर।